Welcome, everybody. We love that everybody's here today. Cynthia Murphy, Head of Research for the ETF Think Tank. We have a great show today. We're going to dive into private equity with some real experts in the space who will introduce themselves in a minute. David, you want to introduce yourself next?
Absolutely. Thank you, Cynthia. David Chikansky here, Portfolio Manager with Title Financial Group, focusing on the gig economy ETF BYOB, as well as the Amplify Inflation Fighting ETF. Today, we'll be talking about private equity, how that relates to the public markets, opportunities that they see, and how that might affect your public portfolios as well. I'll pass it on to Tyler Bain to introduce himself.
Yeah, thank you. Tyler Bain here in Denver, Colorado with Primark Capital. Glad to be a part of this show today. And one of the things that we're very proud of is we were able to launch one of the very first private equity funds that has trade settlement on all the major custodial platforms like TD Ameritrade, Charles Schwab, Fidelity, and allowing wealth managers to simply trade via ticker. And really scaling pure private equity across their entire book of business with a very simple trade. No investor restrictions or sub-documents are needed.
Steve, you want to introduce yourself?
Sure. Thank you, Cynthia. Steve McCourt. I'm co-CEO of Meketa Investment Group. I've been at Meketa and working in the institutional investment advisory world for 29 years. Meketa, for those of you who don't know us, is one of the largest institutional consulting firms in the US. We work with roughly 250 institutions with somewhere between $1.5 and $2 trillion of assets that we advise across all asset classes, but have a specialty within the private markets broadly. We're here today largely to talk about private equity, and Meketa has been engaged by Primark to be the discretionary sub-advisor for the Primark private equity vehicle. So that's our connection with Tyler. Thank you again.
So Cynthia, you want to start with the first question, or you want me to
You
go
don't need
first?
to. You don't need to remind everybody you're the ETF professor. You haven't.
Oh yeah,
done
I'm the
your,
ETF professor.
Yeah,
I'm the
please. We may have
sorry.
forgotten.
ETF professor here. I'm clean shaven these days, by the way, and also the lead ETF strategist for the ETF Think Tank, where hopefully we help advisors build better portfolios. Okay.
So let's kick it off with just kind of level set. I know when we talked, Tyler and I talked earlier this week a little bit, and I thought it was really interesting your comment about how there's so many myths about what private equity is and isn't, and so much misunderstanding about this even as a category. So why don't we just start there and level set, what is it that people get wrong about private equity?
Do you want to take this one, Steve, or?
Yeah, maybe I'll kind of broaden it out even a little bit from there, which is kind of what gets large investors, at least historically, interested in the asset class, what they get wrong about it. Private equity as an asset class has been around for about 40 years at reasonable scale. It's evolved a lot, it's changed a lot over that time period. And really in the last 5 years alone, private equity as a big component of private markets more broadly has elevated to a position of kind of normalcy in asset allocation models for most institutions. The primary reasons that institutions have invested in private equity historically are, first and foremost, potential for higher returns over time, higher risk-adjusted returns over time, and diversification. And the diversification comes in two forms. One, the types of exposure you get to private companies through private equity investment vehicles are somewhat differentiated from the exposure you get in the public stock markets here in the US and around the world. So it allows investors to better diversify their equity investments. And of course, you get the really nice phenomena that we've seen, more recently in the last year, where private equity valuations are both lagged relative to public market prices, and also more muted. So typically, private market assets go down less than public market assets do in price or in valuation, Dan.
That's the word, guys, valuation.
when markets go down, and likewise, when markets go up, public markets go up, private equity tends to go up a fraction of that. So it's a more stable asset just by the way the valuations in private markets work. Valuation is the toasting word of today, I was told. So it's good so far.
So is it? I was going to ask, is it more muted because of the lower kind of fundamentals, just based on the category of what you guys are looking at, right? It's really just like free cash flow versus a growth-oriented name.
There's a few things going on. Primarily, the reason the valuations are more muted is because when valuation experts take sort of an objective look of what a company is worth, you're generally not going to take an extreme position on a given day. You're generally doing the valuations, 3 months after the period you're valuing. You have the benefit of context and hindsight in market activity, and so valuations tend to be a little more reasonable in their approach, where in the markets, markets are often driven by psychology, fear and greed that can be really sort of extreme depending on the market environment. So the fact that private assets are valued through a process itself means that you kind of strip out a lot of the psychological volatility that afflicts public markets. There's also some compositional differences as well. There's different types of companies that are owned by private equity managers and different types in the public markets. But if you're looking at traditional kind of small and mid-market buyout private equity strategies, and I'm sure we'll get into kind of the sectors within private equity, which is the type that Primark is focused on, those tend not to be companies that are constantly burning cash. They're generally generating EBITDA and are self-financing from that respect. And the public markets increasingly, of the last few years anyway, have included more and more companies that need to constantly go out to the debt markets to refinance or roll over debt in their businesses in order to keep operations going. So it's possible to create a private equity portfolio that is compositionally focused on companies that are free cash flow generating companies, and not like a lot of the venture capital or technology companies that we see in the public markets today.
So on that, can you run by us the differences specific of venture versus mid-market versus late stage private equity in terms of opportunity?
Yeah, absolutely. So first of all, I'll kind of differentiate across kind of broader private markets and the way institutions view all of these illiquid asset classes. So generally you have real estate, which is obviously its own kind of animal within the private market category. You now have private credit, which is a fairly established asset class institutionally, where managers allocate debt capital to businesses of various types. You have real assets, which might include infrastructure, natural resource type strategies that provide some level of inflation protection in the assets that they invest in. And each of those broad categories has their own little ecosystems with their own definitions and nomenclature, and subcategories within them. Private equity, historically, the two broad categories were buyouts and venture. And going back 20 years, the major distinction between them was that buyout strategies typically targeted businesses that were cash flow positive. Many buyout managers used existing cash flow to finance additional debt load on the businesses. And the buyout managers would generally grow the businesses through operational enhancements and or buy and build strategies to get a higher multiple on the EBITDA at exit. That's the classic buyout sector. The classic venture sector was coming up with some reasonable valuation for a business that had yet to generate revenues at the seed level and had yet to generate any cash flow even at later stages of development and capital deployment. So as time goes on and things naturally evolve, the buyout sleeve in its own started to get segmented as well between sort of small and mid-market buyouts and larger buyouts. And a new category, arose for growth equity, which was sort of between venture and buyouts, where typically managers are providing growth capital to businesses. The businesses are often cash flow generating and cash flow growing, but the buyout manager, instead of buying a control share of the company to execute a plan to improve operations, they're providing, generally with a minority stake, growth capital to help the existing management team grow the business and the revenues, but still generally cash flow positive and growing businesses. Growth equity has typically and probably obviously been focused on higher growth sectors of the economy like technology. So growth equity investments tend to be more focused on growthier segments of the economy, where buyouts are more diversified across the overall economy. And venture today is now kind of sliced into several different pie pieces, from early stage to later stage, and obviously a lot of venture managers have gotten into growth equity as well. So each of these categories has evolved to become within themselves more complex and specialized.
Steve, you missed a big opportunity, by the way. I should have told you in advance. We're owned by a private equity shop, Title. I'm sure if Venuta was on, he would have highlighted that. I'm not sure where you would categorize an ETF boutique in your pool of capital. So I guess if I had a question, starting with like kind of the deep dive, if interest rates are higher today than they were before, and people are talking about concerns around credit, walk us through your vision on where credit is going to lay out over the next year, because candidly there are a lot of concerns around private equity and how they're going to muster through a credit crisis if one does occur.
Yeah, it's it is going to be a challenging environment for all businesses, whether they're owned by private equity or not. Any business that has to rely on the credit markets in some fashion. In the private equity world, it's less relying on credit markets for ongoing operations and more relying on credit markets for executing new deals. And exiting deals, because you're generally selling, in today's world, fewer and fewer IPOs, you're generally selling your companies to other private equity owners who need active credit markets to support the exit valuations that you demand as a buyer. So so far, I would say the impact of rising rates on private equity operations have been fairly marginal. And the main reason for that is if there's a recession coming, down the road, it would be the most highly advertised recession in the history of recessions in America. I mean, it's almost been a year that the marketplace has been talking about how obviously rising interest rates would lead to softening in the economy. And so it's given time for companies to prepare for a recession. And private equity owned businesses, and you work for one, Dan, so you probably know this, they're cutthroat. And they're typically the first to cut costs if they sniff softening in their business. And as a consequence, they tend to, and they also tend to raise cash as well. Their businesses tend to be on the resilient side during recessionary periods. So we saw a lot of the businesses that the private equity general partners we work with invest in start to really prepare for a recession third quarter of last year. Yet fundamentals for companies in general, by and large, have stayed fairly positive, certainly in the fourth quarter. And first quarter is probably a little too early to declare victory on, but certainly no cliff in revenues or EBITDA. So in the context of that, there hasn't been yet a meaningful impact of rising rates on operations of private equity owned businesses, but there still very well could be. What has happened is transaction volume has come down a lot. Very little selling of private equity owned businesses is happening today, and much like a lot of other markets, there's a gap that has widened out between what sellers value their businesses at and what buyers are willing to buy the businesses at in the context of economic uncertainty. Some of that economic uncertainty related to the level of interest rates, some of it evolving banking crises and fear and other things like that. So the transaction volume has certainly diminished quite a bit in the last 6 to 9 months, but it hasn't gone long enough to cause private equity managers to capitulate on prices of companies. And so when and where buyers and sellers sort of meet on valuations of businesses is still to be determined. All else equal, and all of you are in the financial markets, you know this, all else equal, when interest rates are higher, assets are priced lower. So you would think that private equity owned businesses, much like common stocks and much like real estate, are going to see their valuations go down somewhat. The only question is, are they going to go down 5% or 15% or 20%? That's utterly unknown, and really just a function of whether we have a soft landing or a hard landing or continued growth in the economy.
And the one thing I'll question you on there is the effects of interest rates on the market, just because we're 1 year and 6 days into the since the first interest rate hike last year. So there's quite a bit of a lag effect on its effect flowing through the entire economy. So I think it's kind of early to call that as like a past tense thing, at least in my opinion. But I guess what I would ask you is, so I know a lot of the venture world is dependent on callable capital, right? And a lot on the credit of their LP. How much of the private equity world is callable on the credit of their LPs and leveraged off that credit with banks, or how much of it is actually just like physical cash in the funds?
Meaning how sure is the capital that LPs commit to the funds?
Exactly. Yeah, exactly. I know.
Yeah, and I'll round up and say 100% secure. The institutions that commit to private equity funds are not leveraged themselves. They're largely pension funds and endowments. Private equity is generally 5 or 10% of their overall portfolios. And the commitment they make to private equity vehicles is a legally binding commitment. So there's not a real risk of institutions defaulting on commitments or not following through on commitments once they make them. And the vast majority of commitments to private equity comes from large institutions. What is happening in the institutional world is because performance has been so strong in private equity versus public markets, allocations have increased significantly. And we had private equity in 2021 was up like 70%. Equity markets were up 30%. 2022 private equity will end up being about flat for the year when public equity was down 20%. So what that does in an asset allocation, what's called the denominator effect, is you have an asset class that is stable or up in value when most of your assets are shrinking, both bonds and stocks. So if you came into 2021 with a private equity allocation of 5%, you're probably sitting at about 9% today. Just not because you've done anything, you haven't added more capital to the asset class, but it just performs so much better. So because of that denominator effect, many institutions have allocations to private equity that are higher than their targets. So the amount they commit to new private equity funds this year is likely to be lower than they've committed in past years, because that's the only way they can assure themselves that in 5 or 10 years, that private equity allocation will migrate back down to their policy target. So the general partners are clamoring to kind of fight for allocations early this year from all the big public investors because there's less money to go around from them. But the money that is committed to the managers is it's rock solid.
Then I think there was a question from Eric. It looks like he's on the phone. Do you want to ask that question on his behalf? Because I think it relates a little bit to this.
I don't see his. Is there a question from Eric? Let's see. Eric. Okay, you ready for this one? Steve, I guess this is directed at Steve. What is the best approximation for Macaulay duration of a typical LP stake? Now, I warned you about Eric. This is softball for you.
So if you're investing in a single fund, the way the capital is drawn and distributed is that there's an investment period of generally 3 to 5 years. Practically, it's more like 2 to 3 years, where the general partner can call your capital from you. So the first thing to note is that it doesn't go out the door on day one. It gets called from you over the course of 2 or 3 years when the private equity manager identifies a company to buy and closes on that company. Once your capital goes out the door to the private equity manager, the manager holds the capital for, on average, 5 to 7 years. On the short side, maybe 3 years. On the long side, 12 to 15 years if a company can't be sold easily. So it's a range, and on a total portfolio, I would say the average duration of the cash flows is something like 7 or 8 years. If the question relates to the Macaulay duration of, like of a bond portfolio and the sensitivity of private equity valuations to changes in interest rates, that is from a quantitative perspective, there's very little correlation between interest rates and private equity valuations. But a lot of the reason there's a low correlation there is because of the valuation methodology of private equity. But nonetheless, the technical duration would be very low because the correlation is very low between bonds and private equity.
It's funny, it's almost as if like the more unprofitable the S&P 500 gets, the better of an opportunity set you guys have from an valuation perspective, right? Like as we talked about before the show, more and more companies are coming to the public market that still need continuous capital, are going to be issuing equity to grow over time. Whereas you guys are focused more on the stronger free cash flow, or companies that can soon to have stronger free cash flow spaces. So what is the risk in this asset class, right? We can't leave this call feeling as this being like, let's sell everything and just go straight to private equity. What are the risks that you see in this industry going forward in this market environment?
Yeah, great question. So a lot of the risk I would pool under a category of execution risks. And these are risks that in the institutional world that we work in have more or less been solved in the last decade. Most institutions approach private equity in a similar way that mitigates a lot of the execution risk. But to the extent that you have an audience today that is investing in the asset class for the first time, I want to highlight what those are, because if you get the execution wrong, it can be really painful. Managing the execution risk of private equity is all about ensuring that you're diversified. And diversifying in private equity is harder than diversifying in public equity. You can't just buy an index fund. And so the first thing is you have to invest in lots of private equity assets to make sure that you're not overly exposed to any one asset, because, well, I said before, generally valuations are stable over time. Correlations are low on a mathematical scale, but that's only true if you have a fully diversified private equity portfolio and program. If you only have investments in a handful of private equity assets, they can be extraordinarily volatile and extraordinarily risky. So key number one is to diversify across a lot of different assets so you don't have outsized idiosyncratic company risk, because it can be as high here as investing in a single stock and calling that your stock portfolio. Two, you need to be smart and be diversified across industry sectors and general risk factors. Three, and this is what's really different between diversification within private equity and diversification across public stocks, you have to be diversified across what we call vintage years, because every private equity investment is both an investment in a company, but also a purchase and a sale of that company at a point in time that has a valuation connected to it. Some years, like 2005, 6, and 7, valuations are high, and forward-looking returns, as a consequence, are more muted. Other years, like 2009 and 10, generally when there's financial distress, valuations are low and forward-looking returns are much higher. If you invested all of your private equity capital in 2007 because it was the hot thing to do, and you thought it would outperform stocks, you were right. That vintage outperformed public stocks over the next decade, but you would have missed out on the best vintages to invest in the asset class in 2009, 10, and 11. So different vintages of transactions can result in very different returns for a private equity portfolio. So you also have to be diversified across years. And as a consequence, it can take a long time to get invested in private equity in the right way. So those are the execution risks. Investing in a very diversified way across time, in addition to across industries and individual companies, without a lot of concentration. Other big risks to the asset class: one, liquidity. The largest institutions can invest in this asset class because it's 5 or 10 or 15% of their overall portfolio. Their portfolio is not leveraged. They can easily come up with capital to support the capital calls into private equity. As an investor, you never want to be in a position to have to sell private equity on the secondary market. Depending on the market environment, you can take a pretty big haircut when you do so. So
that was actually going to be my next question, is that obviously not all institutional players are created equal and some are in different positions. And is there an increased demand for secondary market of these private equity holdings? And I'll tie in a question that Jim just posted to the group into that. Like, how would you advise a high net worth individual to get that kind of diversification from both the manager and vintage perspective?
Yeah, I mean, first question first. The secondary market within private equity has become yet its own ecosystem as well. So there's private equity investors that transact billions and billions and billions of dollars every single year, buying and selling limited partner interests in private equity funds, and that market has been around for 30 years. Institutions will use that market as a way to purchase private equity assets at a discount when discounts are available. And sometimes, like right now, a lot of large institutions may sell their private equity interest in the secondary market as a way to opportunistically get their private equity allocations down to target. So private equity, the secondary market for the last couple of years, has been priced pretty close to par for a lot of assets. And so if you're a seller, if you wanted to get out of private equity, if you wanted to sell excess capital you had there, you could do so in the last couple of years with a limited haircut on your net asset value of that fund. And so institutions both buy and sell in the secondary market, depending on kind of what stage of development they're in, what allocations are relative to their targets, and what discounts are in the secondary market. In terms of your audience and investors generally that are getting into the asset class for the first time, like everything, the first thing I would highlight is educate yourself. Don't invest in any new asset class until you feel like you fully understand it, and you've asked all the questions you need to ask to get yourself and your clients comfortable with it. Private equity, like every asset class, has idiosyncrasies. It has risks. It has challenges, and like other asset classes, there should be a kind of appropriate thought and research put into the asset class before you commit you or your client's assets to it. The other thing I would highlight is just get into it in a very kind of long-term way. Private equity is a long-term asset class. It's a fantastic asset class for investors that truly have a 10 or 20 year or longer time frame, and that's really what attracted the institutions to it. Finishing off my thoughts on risks you asked earlier, probably the biggest risk is the risk of regret in the asset class. Don't get into it if you don't think you can afford the illiquidity, or you're not confident it's gonna be part of your long-term strategic allocation for the next couple of decades. Because the biggest historical losses in private equity didn't result from private equity losses in diversified, well-structured portfolios. It resulted from investors who had their own liquidity issues and had to sell their illiquid private equity assets at a loss. And I think if you can avoid, the more you can do to avoid that, the more you mitigate really the left tail of the private equity distribution.
Hey, Steve, can you also touch a little bit on, we're obviously an intermediated asset, and advisors are mostly looking at kind of, reducing small and mid cap allocations. A lot of that because of the number of listed companies. Secondly, the degradation of earnings. Can you just give a perspective from Meketa's view on how you view small companies in the public markets, and then kind of juxtapose that to middle market private equity?
Yeah. Thanks, Tyler. We'll do. So the reason, as I mentioned, one of the big reasons why institutions began adopting private equity as an asset class decades ago was that private equity vehicles provided exposure to companies that you didn't get exposure through your public equity investments. At that time, mostly because the companies were too small to go public. And to a certain extent, that's still true. There's a lot of assets held by private equity managers that, their companies worth $200, $300, $400 million that it would be a stretch for them to go public, not because they don't generate cash flow, but just because there's not sufficient liquidity in the markets to go public. But one of the big sea changes in the private equity industry was Sarbanes-Oxley back in 2002-ish or so, which really made it more painful from a regulatory perspective and expensive for companies to go public at all. And starting then, you had an increasing drumbeat of companies that, at a minimum, didn't see an IPO as the necessary exit for them and could see themselves growing as a private company in perpetuity. And you started to have private equity owned businesses purchased, grown, and sold to another private equity manager who would purchase it, grow it some more, and sell it again. So you had sort of this these exit opportunities within the private equity asset class that became more and more common as private companies didn't see IPOing as the only way to generate value for shareholders. And as time has gone on, that has sort of continued to evolve in the same direction. You all probably know that there's far fewer stocks that trade publicly today than existed in the late 1990s. That number has been low and fairly static for the last several years. There's not a lot of public policy support to increase the number of IPOs generally. And as a practitioner, I would say, if anything, the last 5 years has taught me where the action is in the markets, both good and bad, are with big liquid names. And small cap stocks have become sort of overseen by most investors generally. So increasingly, I think what Tyler's leading question is, a lot of institutions are starting to see private equity as well as a replacement to small cap stocks within their portfolios, where 20 to 30 years ago, it was fairly common to see institutions, as a matter of policy, overweight small cap stocks in the market because of the presumed small cap premium. Today, most institutions don't fool around with overweighting small caps. They generally kind of market weight them and get the overweight towards smaller companies through their private equity portfolios. But the other thing you reminded me of, Tyler, is now that I spent 40 minutes here and haven't even mentioned co-investments yet, which is what we do with Primark, yet another sort of evolution and sleeve to private equity has been co-investing. And this is a really interesting and useful one. So the one of the challenges and risks of private equity investing is the fees. Obviously, they're enormous, and a lot of our clients, which are large public pension plans, find them very challenging from a political standpoint and PR standpoint. But even if you can stomach the notion of private equity general partners making billions of dollars off of other people's capital, those billions of dollars add up to returns as well. And so, from Meketa's perspective and that of most institutions, the fund vehicles, which have been the primary way that institutions have gotten access to private equity historically, have loads of fees associated with them. The two big ones are the management fee, which is almost always on committed assets, not on invested assets, and the carried interest, which isn't a fee, except that it's a fee that goes to the managers when they make a lot of money. Together, if you look at those fees over the last 15 or 20 years, for an investor that's in a fund-based program, and let's say, for sake of argument, that investor, net of all the fees, return 13-14% per year, which is about the average return for private equity net of fees in the last 15 years. In order to create that 13% net return, the general partner for those funds had to produce a gross of fee return of 20, 21, 22%. There's about a 5 to 7% differential between the gross return and the net return. You can call it management fee, you can call it carried interest, you can call it what you want. It's money that's going to the general partner, not to the limited partner. And so in this institutional world, there's been a lot of work done to try to reduce that ultimate fee load to make the asset class more generating for the limited partners. Because private equity managers have been very resistant to negotiate fees, and they like their 2 and 20 model, they instead went a different route, and they went to their largest investors and they said, okay, we're not going to negotiate off our 2 and 20, because that means we'd have to negotiate for all of our investors off of 2 and 20, and that doesn't sound like any fun. But because you're $20 billion institution and you're going to commit $500 million to my fund, for every $100 million that you commit to my fund, I'll give you access to $100 million of co-investment in individual deals that I invest the fund in at no fee, no carry. So if you invest in all of the deals on a co-invested basis, you cut the fees in half. And that's called co-investing. And so now a lot of large institutions not only commit to fund vehicles, they also commit to co-investments with those same general partners at no fee, no carry. The cool thing about the Primark vehicle that Tyler and Michael Bell set up is that it's largely co-investments. So we're targeting like 60 to 80% of the portfolio to be co-investments that are no fee, no carry. And Meketa has access to that because of all of the commitment that we, as an advisor and aggregator in the institutional world, allocate to fund vehicles and general partners. So the Primark vehicle is able to deliver a diversified private equity portfolio through co-investments that, instead of a 5 to 7% fee load per year, is going to be something closer to 2 to 3% per year. Which is a nice level to be at and kind of gives you a advantage over other private equity investors. So it's one of the reasons we're very excited to be working with Primark, but a really kind of interesting evolution in the private equity industry as well.
Well, I think Ray's had his hand up first, and then we'll go to Lily shortly thereafter. Go for it, Ray.
Thanks, Dan. Thanks, everybody. And I'm not sure if this is for Steve or for Tyler, but I've got sort of a two-part question, and we've sort of been dancing around it. So I mean, you've already answered probably pieces of this, but I think at some point, I think I've heard somebody say structure matters, and so it looks like, and I mean, it may be more complicated than this, but it seems like in the private equity world now, you basically seem to have at least three different channels. You've got the institutional channel where people are going directly for deals. You've got the case iCapital sort of channel where your QP investor gets involved. And then you have the interval fund channel where basically everybody can kind of get involved in this game. So that was one thing as far as just to maybe compare and contrast the differences there. And again, you've already done some of that. And then again, I think you also answered part of this other question was sort of for Tyler, what versus primary, secondaries, as far as to the extent you can speak to it, what Primark is actually, where you're actually trying to put assets.
Yeah, no, I'll take this one, Steve. Yeah, in regards to kind of the allocation, you mentioned iCapital and Case. These are great firms, right? You got Opto out there. You got Proteus, and so there's a lot of money being spent on the technology side, and they've done a really good job of creating, kind of curated, private market investments, whether it's private equity or real estate or private credit and so on. And so what they will do is just automate, all the sub docs. They will help advisors and wealth managers just create some efficiencies from that standpoint. Michael Bell, my partner, our partner, was unfortunately on a plane, and he just kept looking at this and going, yep, we applaud what they're doing. It's amazing. They're opening up private markets, but we just felt like there was a better way. Why didn't we just go out and build, a product and just place it on FundServe, which is, if you're an advisor and you're trading at Fidelity or TD or Schwab, every major custodial platform trades on FundServe or NSCC. And so we went around the country. We started to, once we figured out we wanted to be in middle market, we of course wanted to institutionalize that through Meketa, but we wanted a point and click solution. If you think of private equity, it's about 8% of the total investable market, according to Vanguard. So if you're not at 8%, you're making a conscious decision to underweight one of the best performing asset classes. And so when we went out and talked to, hundreds of advisors, we heard a common theme. We want private equity, we want private markets. But when we took a diver deep into their allocations, there was a very minor allocation. And a lot of that was driven through the complexity of managing capital calls, dealing with high minimums, diligence and curating the right general partners, because there is a massive dispersion of returns if you get it wrong. And so it just kind of told us there was no question that advisors were looking for an easy way to eliminate a lot of the friction that comes along with investing in private markets. So we have the only middle market private equity fund. It sits on the FundServe chassis. So Ray, if you wanted to make a trade today, you could simply just enter the ticker PMPEX, hit a button, and tomorrow you'd be invested into middle market private equity. You had a second question, but I didn't write it down. What was the second question?
No, just between prime, I think you sort of answered, you were doing some of those side deals, but as far as in the private space, primary, secondaries, is there a particular point of focus that that you're in?
So since Meketa's taken over, which has been September 1st of 2022, our target allocation in regards to co-investments is 80%. If you look at some of the last, kind of co-investments we've made, they've been alongside very prominent general partners, Partners Group, Temasek, the Sovereign Wealth Fund of Singapore, Onyx. And so that will be the bulk of the portfolio. We are investing in that with no fee, no carry. And then we have 10% that would be allocated into, private fund investments. And these would be both a mix of primaries and secondary funds. And then we have another 10% in marketable securities, which half of that would be in cash. So for the most part, you're going to be, really dislocated from the markets. But I think the big benefit is this single entry point. You're going to be immediately diversified by manager and general partner. Steve talked about vintage year diversification and the importance of that. You're going to be diversified by vintage year, and then of course by industry sector and by portfolio companies.
Thanks.
Thank you.
Lily, you're up.
I'm going to ask a fun question. Do you have any plans on buying any of the defense contracting firms? And if you do any of the owners need to have top security clearance with the U.S. government? Thank you.
So Meketa doesn't buy firms directly, just to be clear. We're allocating capital to managers who in turn purchase companies, and we're co-investing with those managers. There are a handful of managers that specialize in government contracting, and depending on kind of where in the government contracting area they are, they need clearances or other kind of governmental approvals to purchase companies and to operate those companies.
Yeah, the only thing I would add there is if you get a chance and you want to Google one of our co-investments, take a look at Blue Voyant. They do cybersecurity, and they do work with our government. It's an interesting site, but that is in our portfolio today.
So I'm gonna hand it off to Michael Baglio for the next question, and then I got some questions.
Hi, good afternoon. You had mentioned that there's a wide variance between the returns in private equity. And I understand basically it's the top 10 or 20% really accounts for the highest end and then really kind of drops off from there. What would you suggest would be the best way to kind of assess, where to go, what to look at, what metrics to look at?
Yeah, so I think, first of all, I'll try to dispel the myth that it's only the best managers that return a lot and everyone else doesn't. The venture world works that way, and I think we're about to see that in venture kind of play out. But the broad private equity world, when you look at return distributions across strategies, is pretty much a normal distribution. So much like when you're picking active managers and stocks, half are going to be above average, half are going to be below average. And part of what you're trying to do is eliminate those that are likely to be below average. So you end up with a portfolio that consists more of above average managers and strategies. In terms of how to identify those managers, the one interesting twist to private equity is the strategies by their nature are capacity constrained. So many good managers that produce better returns, once they reach a certain amount of assets, $1 billion, $2 billion, $3 billion, they close to new investors. And every time they do a new fund, they only invite their previous investors into the new fund. So there's a lot of good managers that Meketa invests in, other advisors invest in, and we might have invested in over the last 20 years in 5 successive funds that they've generated superior returns in, but new clients can't get invested with them. So that's always a challenge with private equity. I'll just give you my common sense response. Since 22 years ago, I started the private equity practice at Meketa with a team of 1. And my philosophy to selection of managers and strategies was fairly fundamentally simple, and it wasn't incidentally any different than how to approach manager selection within the public markets. You find a good team of people that are experienced at what they do. You find a strategy that is highly repeatable. And can be repeated with success. It isn't dependent on some sort of idiosyncratic event in the marketplace. You find a strategy that can be scaled up without alpha or returns eroding. And you find a team that is credibly in the business for the next 10 to 15 years, not one that might be leaving in 5 years, because in private equity, you're signing 10-year contracts if you're investing in a fund. So to me, it kind of boils down to the basics of manager research. And those are really the types of partners that at the core Meketa, looks for and identifies as superior.
Okay. All right. Thank you.
Thanks, Michael. So a couple of tidbits and questions that I've got. One, Lily, I've been holding back on you, by the way. Maybe 25 years ago, long time ago, a couple of partners and I tried to take control over a small defense contractor. So think about that. They were going to give me the keys, right? I don't know that you always need approval. It may depend on the level of security that the defense contractor has. Then the other thing I would say, this is more of a question for Steve, and then I've got one for Tyler as well. So you're speaking about, I think you mentioned $1.5 trillion that your firm, I'm going to use the word is involved with. You can correct me on that. That is not the leveraged amount. So often I hear about private equity, and I don't hear what the leveraged amount is.
Yeah, so the Meketa, the 1.5, 1.6, $1.7 trillion that we advise that counts all of our clients and the assets at those clients that we have responsibility over. So some of it's private equity, some of it is public equity, some of it is fixed income, some of it is real estate. It's every conceivable asset class. And we have some clients, large public funds that'll hire us just to advise them on private equity, but not on their traditional asset classes, and we'll account the private equity piece on that. So that's what that number relates to. None of our clients use leverage in a material way, so that number is not leveraged. Private equity asset values, and I'll throw out a number that'll be close in the fairway. We oversee like $150 billion of private equity assets. None of that is leveraged at the LP level.
Right.
The underlying assets have leverage associated with them.
Right. That's what I'm looking.
Yeah, and so typically the way that works is the average buyout transaction, and this has been fairly consistent since the financial crisis, is between 50 and 60% debt and between 40 and 50% equity. Then what generally happens is during the life of the private equity owned business, that leverage is worked down, because many times one of the ways to accrue value in the business is to buy down the debt over time. So when a company's exited, it might have 25% debt, not 50% debt. So the average debt load is somewhere between that 50 and 25% level. People have done studies on this relative to public stocks. If you exclude the banking sector, which distorts the number, private equity is more. The average private equity business has more leverage than the average publicly traded stock, but not a lot more. You're probably talking about 10% more leverage.
Interesting. So, I'm all about the blockchain, of course. I just wanted to ask, I don't know if there's a question for Steve or Tyler, but have you heard of any private equity deals that you know of being involved in the blockchain doing transactions? Because I know that, as an example, Apollo has offered some of their deals, their funds, on Provenance blockchain. And if you don't, I'll hook you up, Tyler, and you can review it.
Yeah, I'll answer for us. There has been attempts and a movement in that direction, really going back 10 years or so, particularly in the secondary market, because there's been a lot of work on trying to figure out how to do secondary transactions in private equity without the involvement of lawyers and multiple parties reviewing tens of thousands of pages of LPAs and side letters and stuff. So we do see it periodically, and it definitely has a potential to reduce the bureaucraticness of the asset class, which is one of the big reasons why individual investors haven't been invested in private equity historically.
So, okay. Tyler, no comment, right? Because we're going to wrap up. You're muted. So, yeah, Cynthia,
no comment.
Cynthia, you want to bring us home? You do that so well.
Welcome home, everybody. It's time to go. Just a quick couple things. One is we've been struggling actually to share a QR code. It's a QR code that Tyler is offering for more information about accessing private equity. So if you guys can't click on that and you would like it, just shoot us a line. We're happy to share it. And just a quick plug as well, if you are considering or if you'd like to go to the Wealth Management Edge conference coming up, which is Edge, RA Edge, Inside ETFs and Wealth Stack all together, is at the end of May. We're actually going to be partners in that event, media partners, which is new for us. And so we have a discount code. So if any of you are interested in attending, hit us for that discount code and join us at another conference. As always, thanks so much, everybody, for joining. Thanks, Steve. Thanks, Tyler, for coming and sharing your expertise with us. And thanks, everybody, for joining us. And we'll see you next week.
Pay
Thank you,
attention to
guys.
valuation.
Yeah, exactly.
Bye, everyone.
Good
Thanks,
night.
everyone. Bye-bye.